Hi, it's Sophie. I want to update you the most recent change on the lending guidelines. If you have done pre-approval a couple months ago and you're looking for buying a house here in Silicon Valley and your loan is a jumbo loan, you really need to pay attention to your pre-approval. A few changes that we are aware of recently. The number one change is the requirements for the down payment increased. For example, used to be if you only want to put 10%, 15% for a jumbo loan, that is okay. A lot of lenders can do it. Wells Fargo can do it. Bank of America can do it. Many other large lenders can do it. Now, jumbo loan is any loan that's over $510,000 here in Silicon Valley. They can all categorize them as a jumbo loan. However, now minimum down payment required for jumbo loan by large lenders are 20%. So Wells Fargo require 20%. And for Bank of America, they cannot do 20% anymore. They require 25%. Similar is for Chase. So if your down payment is not bigger enough, if you only have 20% and you had a pre-approval done before, reevaluate your mortgage situation before you go out to buy or put an offer for a house. The second change we see is the calculation of the income is getting more strict. For example, if you are self-employed or if you are not W-2 employee, you cannot provide W-2. When the lender calculates your income, sometimes they even count 70 or 80% of it. And some lender does not do loans for that type of borrowing anymore. So that's another tightening of the rules we see. And the third big tightening of the rules we see is in terms of the credit score. So used to be if you have 640, 620, that type of credit score, you could get a loan. And now a lot of lenders require minimum 700 for jumbo loan for the credit score. And bear in mind, it's not your highest score because usually they pull 3 bureau score and then they go with the middle score that come from 3 different credit bureaus. So the credit score requirement increased. And the next impact is calculation of rental income. The major change that happened just a couple of days ago with Wells Fargo is they do not count in your rental income anymore. So if you have houses that get rented out and you need to use those rental income to qualify for a certain amount of loan, those income can no longer be counted. So it will impact the total amount of loan you can get from this particular lender. If your current pre-approval is with Wells Fargo and you are using rental income to get the current loan amount, definitely find another lender to do another pre-approval. Because I think some other lenders like Citibank or Chase Bank maybe still be able to count the rental income. Bank of America can still count, but they are pretty strict. They will need to see that house was actually rented out. And rather than just see a lease agreement, they want to make sure it's actually rented out, but they can still count the rental income. And Wells Fargo change is very recent. These are the few changes. And another change is called a non-qualified loan is gone. What is non-qualified loan are the ones that, for example, you cannot check your income if you're foreigners. These are the loans, a lot of time it's done by wholesale mortgage lenders. A lot of times they can do this kind of loan before, but no longer available anymore because the investor, once they finish the loan, they usually sell to the investors so they can loan you again to give the loan to more borrowers again. There are very, very few investors willing to purchase loan of this kind of higher risk loans. So the non-qualified mortgage are gone as well. These are a few major changes. If you are looking to get a mortgage to buy a house recently, you definitely need to keep them in mind. My advice is whoever did your pre-approval before, go back to double check with them the latest rules. And if you're not sure if you are putting an offer, remember to put a loan contingency as a protection clause. And another reason I advise you to do that is lender is verifying your employment status more frequent and also more hard in the sense that if they already verified you're employed they will verify again. Just the same day they found your loan, they wire the money to the escrow. Before they wire the money to the escrow, they will check to see, either that same day or the day before, to check with your employer to see if you are still having the job. So if when you're buying the house, you still have the job, but somehow in the middle, the day before your deal is about to close, you don't have the job anymore, then the lender will not fund your loan, and then your whole transaction cannot close. So that's another reason you want to be aware and get yourself protected if you feel your company is likely to have any layoff or job change in the middle of your purchase of your home. These are the few things I want to share with you today. A few more notes about why lenders doing that, because they are facing higher risk. One of the things I mentioned in my other video is about forbearance. So this is actually has impact on lender, because if you, I saw the data that as of today, there are about 7% of the all mortgage in United States actually was in forbearance status, which means for these group of people, the bank cannot collect mortgage for at least 6 months, or sometimes maybe even longer, for 12 months. However, the lenders still need to pay those money to the investor. So because of that, they need to keep more funds in their reserve to be able to handle a scenario like that. And that also impact the amount of funds they want to lend it out, and also impact their evaluation of the risk they need to handle. These all have impact on lending decision, and as a result, had impact on lender change of the guidelines. So if you want to check more details about forbearance, you can watch my forbearance video. I put the link underneath here for you. That's all for today. Hopefully this is helpful for you if you're in the middle of getting a loan or looking to buy a house. Even for refinance, the lender has some change as well. For example, like Wells Fargo, they don't want to do refinance anymore. They want to just focus on purchase loan. If you want to refinance with them, they want the people they are still doing refinance are the people who have at least $250,000 assets in that bank. So for refinance, there's some impact as well. If there's any other new change, I'll keep you guys updated. And meanwhile, stay safe and sound. And if you like our video, please subscribe it, share it, or give us a thumb up. Thanks very much for watching.